Good afternoon, I'm Marcus De Silva and welcome to the second instalment of Trust TV, a webinar series that gives you, the investor, exclusive access to Janus Henderson's investment trust managers and the opportunity to have your questions answered here live in the studio today. I'm delighted to be joined by five-time AIC Freelance Journalist of the Year, Cherry Reynard, whose work is included in publications such as The Telegraph, Investors Chronicle, Money Observer, Morningstar and Investment Week, to name but a few. Now, using the live Q&A facility on your screen, you can ask anything from portfolio management to stock selection to macroeconomics, and I will get as many of them answered as possible throughout today's programme. So please don't hesitate to put our fund manager on the spot whenever that burning question comes to mind. So let's begin with a short introduction to today's investment trust manager.
The City of London Investment Trust can trace its roots back to the 19th century as a brewery, but its journey as an investment trust began in the 1960s. The trust has increased its dividend payments to shareholders every year since 1966, a record unbeaten in the investment trust universe. Since 1991, Job Curtis has overseen the management of the trust's portfolio, which invests mainly in the UK, the world's second largest equity market, and focuses on large companies with the objective of growing shareholder income and capital. Job successfully steered the trust through the economic crisis and is now navigating it through the UK's exit from the EU. We now join Job and financial journalist Cherry Reynard to discuss the investment landscape for large UK companies and how the trust is positioned to generate shareholder returns.
So, the City of London Investment Trust aims to provide long-term growth in both income and capital, principally by investing in equities that shares listed on the London Stock Exchange. Broadly, it is a FTSE 100 blue chip portfolio, but it has some cash invested in smaller companies as well as some overseas. Job has been managing City since 1991, so I'm guessing the board and his investors must think he is doing something right. Welcome, Cherry and Job. So, Job, let's start. What makes City of London special?
Well, I think three things come to my mind. First of all, the long dividend record, which was mentioned in the introduction. It's the longest record of continuous dividend increase of any investment trust going back to 1966. We can talk about how the investment trust structures helped us in that regard. Secondly, we have the lowest charges in our sector, 0.42% in our last financial year ongoing charges ratio. And thirdly, we have got a good longer-term record against the FTSE All-Share. We've significantly outperformed since I became manager in 1991, but we don't outperform every year. There are some years when we underperform. Overall, on the long run, we have delivered outperformance.
Okay, well, let's start with fees. It has some of the lowest in the open-ended side, but in the closed-ended it is the lowest. So why are they so low? How do you make them so low?
Well, I think that's one of the way an independent board of directors comes into play, which open-ended funds don't have. And so the independent board of directors for City of London has the 5 directors, and they're there to negotiate the fee rate with Janus Henderson, who I represent as the portfolio manager. And so they've done that negotiation. We're quite a big trust, £1.5 billion worth of assets. So it is a good fee for Janus Henderson, I'm pleased to say as well.
Cherry, how important are low fees to investors?
I think people really want to see that they're not being ripped off. So they want to, they want a reasonable fee and a reasonable product at the end of it. I think that's really important. And also simplicity, I think, is really important. So yeah, I think it matters. And I think, it's a good challenge to the passive sector that when you have fees as low as this in an active fund.
Mm-hmm. Okay. Let's look to the dividend record. You've got 51 years of consecutively raising your dividend for investors. And I think interestingly, you've also had 5 years of growing the revenue reserve. So do you want to talk a little bit about these things that we brought in and why?
So as an investment trust, you don't have to distribute all your income every year. You can hold back up to 15%. So in the good years, we hold back a bit and put it into revenue reserve. So it means in difficult years, such as during the financial crisis when a lot of companies cut their dividends and our income actually went down, you can use that revenue reserve to grow the dividend. So it's like a smoothing effect. And And certainly in the 27 years I've been manager, 7 of them, we've had to use the revenue reserves, and we haven't needed it in the last 5 years. We've added to revenue reserves, but I'm sure going forward in the future there'll come a time when we need to use revenue reserves again.
Again, Cherry, do you think this is important, these dividend records for investors?
Yeah, I really do. And I think even if investors aren't aware how important it really is important, because almost everything they're saving for requires this kind of growing income. So if they're saving for school fees or retirement or, I don't know, anything, holidays, whatever, it requires this growing income, and I think it's really, really important.
Okay, brilliant. And if we look to the trust rating as well, it's got a 4-star Morningstar rating. How important do you think, actually to Cherry, how important do you think these ratings are?
I think they're nice to have. They're a kind of reassurance for investors that they're getting a good product. But I'm not sure they possibly understand the nuances of how the ratings are assigned and those kind of things. I mean, it's a nice little rubber stamp.
Okay, we've got a question actually from the audience already. We're wondering what your thoughts are on British Land. So we're getting straight into the stocks there. Given the significant discount to NAV that they are trading on.
Yes, we hold British Land in the portfolio. It's our second biggest stock in our real estate sector. We've got about 4.5% of the fund in real estate investment trusts, and it's on a discount to its net asset value of about 30%, and that reflects pessimism in the stock market about the city office market ahead of Brexit. I mean, they have got quite large investments in the London office market, British Land, and their other main area is retail, and of course people are very pessimistic about that. But I personally think that on a 30% discount to net assets value, it's quite interesting, and also they've got very high quality tenants on long leases and really blue chip clients, and so I think from an income point of view it looks quite interesting, and their cost of debt's very low. So to be honest, I can't see a catalyst coming up that's going to sort of provoke the share price to move out of its slight torpor. But I think longer term it looks quite interesting.
Good. Okay, so we're going to move on to the structure. I mean, this is an investment trust. It's a closed-ended structure. So how important do you think this closed-ended structure versus the open-ended OICs, as we call them, is for performance purposes?
Well, I think we've talked about the dividend performance, which could only be achieved through the revenue reserves. I mean, you wouldn't be able to do that on an open-ended fund, in my opinion. You've got the independent board of directors, which I think it plays a really important role. And then there's also gearing, and as a PLC, you are allowed to borrow. And we're a conservative trust, but we do have, we can use borrowings to enhance our performance, and we can borrow very cheaply. I mean, we've recently, last September, we borrowed 50 million pounds at 2.94% for 32 years, and that's not over a very long period, over 32 years, and it's an exceptionally cheap level to borrow at, and we're really taking a view that our portfolio can achieve a better annual return than 2.94 over that very long time period, not every year, but over a very long time period. And so I think this should add value over the long term, and it's certainly gearing is a way that investment trusts can differentiate themselves against open-ended.
Cherry, are you a fan? Do you invest in investment trusts?
Yes, I do, actually almost exclusively, which probably makes me a little impartial. But there was some very interesting research recently from Cas Business School, which looked at kind of open-ended versus closed-ended, and I think it's extremely difficult to do, but it even stripped out the effect of gearing and the fact that investment trusts tend to invest in certain sort of better performing assets, and so it stripped out the effect of it and still found that investment trusts tended to outperform, and the main reason was this flexibility that it gave to the investment managers, and that they don't need to manage inflows and outflows all the time. I mean, Jim, I don't know how you find that in the fund, but it was obviously a really important factor that they weren't having to manage liquidity in the
That's
in the
interesting,
trust.
because a lot of the research where they've seen closed-ended versus open-ended, people tend to focus on the gearing, on the borrowing aspect that's leveraging returns, but that seems to imply something more than that.
Yes, I mean the gearing I think also added value, but they stripped out that effect. So I think it was and it was sort of independent proof. I think that investment trusts are quite, are important and a good structure.
How about the board of directors, Joe? Do you find them useful?
Yes, definitely. I mean, we meet 7 times a year, and it's they sort of act as a critical friend in a way. They are, they want the manager to succeed, but then they're always there to ask the questions, and that keeps me on my toes and makes me very well prepared for other investor meetings as well. So, but it's definitely very good to sit down with. I mean, obviously we do a lot of peer review within Janus Henderson as well, but to have some outside independent directors it adds a lot of extra value for sure.
And with the gearing, how do you decide when to use it? Because people hear leverage and they think a lot of risk. How do you use this facility?
Well, you're right to make that point, because in a falling market, gearing will act against you. So you do need to bear that in mind. But I think we've got these longer term borrowings, which I see as kind of strategic, really. And unless the market gets very expensive, I'm inclined to keep that money invested. So at the moment, the end of June, our gearing was 7.8%, which represented our fixed rate borrowings. And then we've got some tactical borrowings, which is kind of more opportunistic for a bank facility, which at the moment is uninvested. So we're sort of with it, we've got a relatively conservative portfolio. So within the scheme of things, we're at probably middle of our range, to middle to lower end of our range.
And presumably you can borrow at reasonably low rates at this juncture. Yeah.
Yes, I mean, this recent one we've done obviously we think is a very attractive rate, and the bank, in terms of our bank borrowings, we're paying 1.75 all costs in. So it is compared with the equity market yielding around 3.6%. It's you get immediate positive carry on the income side.
Yeah.
Do you think it would be more useful if lots of funds had independent boards?
It's interesting. I mean, I think what Joe describes is exactly the way it should work, where you get this dialogue where the board challenges. I mean, I have seen examples of bad boards as well, and there have been some sort of controversial actions by boards on some of the other trusts. But I think the concept is really good, and the way of keeping a manager honest, I think, is very good. I think there's a real move in the sector as well for greater diversity on boards, and so that challenge function really works as it should. So I think boards in general are improving quite a lot.
Their governance. We actually have another question from the audience. Also on Schroders, the FTSE is close to its all-time high, yet Schroders is well off its high. What am I missing?
Yes, we hold the Schroders non-voting shares, which they're 2 classes of Schroders shares, and I think that fund management groups are a bit out of favour at the moment, partly because of increasing costs of regulation, and also we've been losing out a bit to passive managers, index funds. So I think there's that slight cloud over the sector. But I think Schroders, obviously they're a competitor of Janus Henderson, but I think they've got a very strong franchise, and there are a lot of good people over there. So it's one I'm very happy to hold in the portfolio from City London point of view.
Fantastic. So the trust, as its benchmark, it has the FTSE All Share. That includes all size of companies. The portfolio seems majority invested in larger FTSE 100. So why is this its benchmark?
Well, actually, we've got our most important benchmark is the sector. It's the AIC UK Equity Income Sector. That's our prime benchmark, and then we use the FTSE All Share as our index benchmark. We also look at the open-ended UK Equity Income Sector, but the FTSE All Share is the standard measure of the UK market. And actually, although we've got 70% in FTSE 100 companies, that's less than the FTSE All Share. The FTSE All Share weighting is even bigger in the medium-sized and small companies are actually quite a small portion, because you've got some giant companies in the FTSE All Share like Royal Dutch Shell, for example. So I think it's there was a period when we used another benchmark, but I think this, in general, it's a benchmark that most UK managers use, and it's been going since 1962, so it's kind of got a lot of longevity. And the FTSE 100 really just the 100 biggest companies, so I think the FTSE All Share is better, and covers the whole market.
Okay, and why would an investor not buy, I mean, we talk about trackers, they're very cheap. Why would they not buy a tracker over, let's say, City of London?
Well, I think we provide a yield as part of our objective, a yield above the index, and also we've got this consistent dividend growth. I mean, 25% of FTSE 350 companies cut their dividends in the period around the financial crisis, and so I think that the income, part of our overall objective is delivering income, and we can focus on that more than you would get through the index itself.
Okay. How long could the Trust's reserve sustain its dividend level, and has it ever been exhausted in history?
We've never exhausted them. They currently about 80% of the annual cost of a dividend is covered with revenue reserves. So in my period, the most we've been is like 3 years digging into reserves, but in the end, you've got to earn your dividends. So the reserves are there to tide you over for a few years, but in a totally cataclysmic situation, the reserves are ultimately the finite. So in theory, investor trusts are now allowed to pay dividends out of capital, but I don't think that would be welcomed by shareholders. I think you'd be like robbing Peter to pay Paul. So I think in a way you need to be in good companies that consistently grow their dividends, as well as the revenue reserves there to tide you over for a year or two, really.
Mm-hmm. Okay.
I think I was just going to add something on the passive point, because I think there's kind of a philosophical question as well with passive, that fund managers are there to kind of allocate capital to the best companies, and I think passive funds don't naturally have that oversight. It's just it just goes towards the biggest companies, and I think that's a really important and increasingly important role for fund managers, that they are directing capital to the best and most efficient companies, and that's an important role in society.
Yeah.
And so I think that is important for trusts like this as well.
Because we talk about ESG, so environmental social governance, being an increasingly important part of how people view a good company. So clearly you don't have that with a tracker, you don't have that oversight.
You don't have that with the a tracker fund for sure. You can probably get a tracker designed around that basis. I mean, we certainly take corporate governance very seriously. We vote in all shareholder meetings, and we only want to be invested in companies with good corporate governance. And in terms of some of the ESG areas where we've got our focus on income, and we're trying our best to achieve that and to overall total return. And you can find other funds which are more focused on this sort of ESG, environmental, social side, which so there are other funds that do that. But overall corporate governance is very good standards of boards, and executives not getting paid for failure, etc. So that's very important for us.
Mm-hmm. Okay, Joe, let's move on to your portfolio management style. What would you say your style was?
Well, I'd say it's twofold. It's valuation driven, in terms of, I think ultimately share price valuation determines return. So if you buy a really brilliant company but it's hideously expensive, you're likely to end up suffering at some point. Whilst I like to buy kind of good companies but on reasonable ratings. And then the second thing, I'm quite a conservative personality, and I think the fund reflects my personality. And I quite like a spread of investments and companies, particularly in cyclical industries which are prone to ups and downs, to have strong balance sheets. Because in a downturn, if you've got a weak balance sheet, you're owing too much debt to your bank manager, then you're likely to cut your dividend, because you've got to think of your bank manager first. Okay,
well, let's look at some of the portfolio themes. You've got consumer staples, that's a big part of it. It's about 19% of the portfolio at the moment. But there's a lot of talk at the moment about the high street retail crisis, which includes some of these companies. So how are you viewing the sector? Why is this one of your portfolio themes?
Well, consumer includes kind of retail, and we're actually quite modestly weighted in retail. We have got some holdings, and there's value there, but it is a difficult area at the moment with the growth of online shopping, and Amazon in particular but there are pockets of quite interesting companies there, but it's quite difficult, as everyone knows at the moment. But no, I think consumer staples, I'm really thinking of the kind of consumer products companies. The company like Diageo, who makes Scotch whisky, or Unilever, or British American Tobacco. I mean, these companies have been going for a long time, and they're very consistent growers, and so they can consistently grow their dividends, and they're very global as well, with a lot of presence in emerging markets where I think it's a strong secular growth theme. So I do like that part of the market.
Yeah, I was going to ask whether you're paying much attention to this retail.
Well, it creates a lot of headlines, and obviously it's it's a huge problem for some companies, and I think every technological disruption comes with its casualties, but the question is whether this comes with more casualties than most. I suspect we're probably not through the worst of it yet, but as James says, there will be winners from it. There will be consolidation presumably, and it will re-emerge. It will just be different, and I guess that's the beauty of capitalism. But my understanding is that it has been more discretionary spending that has been hit rather than food and Marmite and all these kind of things.
Yes. Of course, the food retailers have had Aldi and Lidl coming up as the hard discounters, so they've been under pressure in that respect. But I think certainly Amazon's, it is more the discretionary side. You're absolutely right. But I totally agree with you. I think in the end, winners will emerge. There'll be companies that can adapt, the strongest companies, and the high street's not going to be a situation where everybody buys everything online. There's at some point online's going to peak, and there can be people who still want to buy, but there'll be a few shops out there and fewer retailers for sure.
Yeah.
So as it's disrupted, are you seeing a lot of merger and acquisition activity?
Well, it's interesting. There isn't that much at the moment in retailing, and I think that's a sign that people can't quite see light at the end of the tunnel. But it'll be an interesting sign when that begins to happen. That might be quite a positive sign when we finally see some more of that.
It's interesting because there's a lot elsewhere, isn't there?
Yes, there is.
And people are obviously, corporate buyers seem to be looking at the UK market and going, "God, there's lots of value there." Weak sterling, and sort of. There seems to have been a good time for certain kind of trophy assets, but yes, obviously nobody's finding any bargains in retail yet.
What would be the effect of a hard Brexit on the fund's strategy in the short term?
Well, I think Brexit, the barometer of Brexit is the pound or sterling, and then that is, as you probably remember, the day after we left the referendum, the pound fell good 10% a few days afterwards against the dollar, and of course that's actually quite positive for a lot of companies in the portfolio, majority companies, because most of the companies in the City London portfolio have got big overseas weightings, and so big overseas operations, and so the value of those profits from overseas and dividends in translated back to sterling will go up if sterling falls, and that did happen after the referendum. But I suppose the impact on the domestic economy could be quite tricky. But we're a very resilient country, but we just have to see what does happen. I don't think anyone really knows. Has got perfect foresight, but it will be. No one quite knows what a hard Brexit really is, but there certainly are scenarios which could be quite disruptive for the domestic economy for sure.
So there's been very much a separation in performance of those stocks that are internationally focused versus those that are domestically focused.
Yes, I think there definitely has, to be honest, and I think the UK, as Cherry was really saying, it's also the whole market has really been discounted a bit against overseas markets because international investors are quite concerned about Brexit, and it's slightly illogical for our big international companies why they should be discounted when they're really just global companies. But so it's certainly having an effect. Something like in the bank sector, we hold Lloyds, it's a reasonably big holding, and I think that's rating is suffering. People are worrying. A bank is a real barometer of domestic economy, and it's been delivering good dividends, but its share price hasn't been going anywhere over the last year, and I think that is partly sentiment over Brexit.
Do you think UK investors are worried about the Brexit issue?
Yes.
But from the point of view from the private investor who would be investing in the funds?
Yes, as you say, in theory, the FTSE 100 in particular is, globally diversified. They're generating their revenues from all over the world, so they shouldn't be that focused on the UK economy, and shouldn't. And yet, it has dented global investor sentiment towards the UK market, and I think even the most internationally diversified companies don't really seem to have been able to escape that. I'm sort of curious to know when the bottom is, sort of when the nadir, because there will be a point, I think, when everyone goes, "Oh, I wish we'd seen that, and I wish we had bought at that point." But I think sentiment is just so tight, and there's so much uncertainty. it would take it's going to take brave people to come in and go, right, this is the moment.
Okay, brilliant. And property, this is another theme within the portfolio. So can you put a bit of colour on this theme?
Yes, well, I like the real estate investment trust structure because the rents come straight through to dividends tax-free. So I think it's a good source of alternative income. And I think City London's in some of the good quality REITs in the sector. I mentioned British Land earlier, and we got Land Securities, and Segro is being two other examples. And I mean, these companies have got the highest quality type of property, but some of the areas of the property market, like City offices, City London offices, or retail, are very out of favour at the moment, even the highest quality. So they're on quite big discounts. So, as I said in the earlier answer to the question about British Land, I think it's difficult to see the catalyst, but I can afford to take a longer term view, and I'm pretty comfortable at this level of discount, and with these, as I see it, attractive income streams and dividend streams. I'm very comfortable with a decent weighting in real estate investment trusts at the moment.
Because a lot of, from the private investor point of view, we tend to hear a lot of news flow around properties flatlining and prices aren't going anywhere and they might decline. But that's obviously not a part of your...
Well, I think you've got to be quite wary of secondary property. I mean, I think all of our local high streets have got empty shops in them, and so that is a real drag on values. But I think the fact that they're standing at discounts already of 30%, the existing net asset values as the valuers value them, means that some of that's in the price already. But it's just no one can quite see a turning point at the moment.
There does seem to have been a fight back on the part of some of the landlords as well against, because they were getting a bit beaten up during some of the insolvency processes, and they seem to be kind of fighting back a bit on that at the moment, which I guess may help them.
Another question here. Would the board consider increasing the trust allowance for overseas holdings if the Brexit deal significantly damages UK economic forecasts?
Well, to stay in the UK equity income sector, we have to have at least 80% in UK listed equities. So at the moment, we've got about 12% in overseas listed, and we've had some good investments overseas. But when I look at the UK stocks we're in, UK listed, I mean, they are very global. I mean, the biggest holding in the fund is Royal Dutch Shell, which is completely multinational. HSBC is the second biggest, and bulk of its business is in Asia Pacific. Third biggest is BP, and so on and so forth. So, in fact, if you look at the top 10, only Lloyds is really a UK-focused stock. So, I would say in our portfolio, we're not particularly exposed to, in the unlikely event, I hope it doesn't happen, there was great disruption in the UK economy. I don't think we have got some domestic exposure, but I wouldn't say we're particularly exposed. And UK's got a great dividend record. It's a good dividend culture in the UK, and it's a decent yielding market and high standards of corporate governance. So I think it's a big stock market. But the US is by far the biggest market globally, but the UK is, after the US, is up there, and so it's not a bad market to be in. So we're pretty comfortable where we are. I can't see us wanting to become an international trust, I must say.
Yeah. You mentioned oil stocks there, so we've got Royal Dutch Shell and BP are in your top three there.
Yes.
You're not concerned, because we've had a lot of, again, news flow around the oil industry with the oil price having been so beaten up, and a lot of cheap shale gas that was coming online, and as well as other producers like Iran and Russia. So this is obviously a theme of yours. So what are the positives of the industry?
Well, actually, whether we like it or not, the demand for oil is growing, and particularly in emerging markets. So world demand grows at around, say, 2% per annum. And because of the slump in the oil price, the oil majors have cut back on a lot of capex, and so we're not getting much new supply coming on. There is a bit of shale oil coming on in the States, but there are some bottlenecks there. So actually the oil price has recovered very sharply from the lows. And I think Royal Dutch Shell did a very good deal during the oil bear market. They bought BG, bought very high quality assets in Brazil, and made them the world leader, or enhanced their position as world leader in LNG, a form of liquefied gas, natural gas. And I think BP's actually done a good job as well in recent years. So I think it's been a mixture of self-help for both companies. They've kind of brought their costs down, maintained their dividends, and now they're really beginning to see the benefit. And the oil price, we can debate longer term, electric vehicles and all the rest of it. There's a lot of other uses of oil, aeroplanes, transportation, and the whole plastic structure. So I think I think there's still a bit of mileage left in the oil sector.
Do you see it as a sunset industry, the oil industry?
I don't. In theory, it should be, but it's difficult to see how much alternative energy sources are making an impact. I mean, there seems to be a lot of technological development there, but I don't know whether they're really issuing a challenge. And actually, I'm wondering whether BP owns some of these alternative energy sources now as well. I mean,
yes, well, they're beginning to move a little bit into electricity supply, but I think certainly natural gas as a form of producing electricity is pretty efficient, and it has got relatively low carbon emissions. Whilst the problem of relying totally on renewables, if you've got a kind of cold, windless night in the middle of winter, you can't, your wind farms and your solar are not going to be working, and you do need a backup. So I think that's until they get the battery technology improved. There is a need for oil and gas, whether we like it or not.
I've got a question here about why tobacco stocks are so weak, given their defensiveness in dollar earnings.
Well, it's been a great sector over the years, but obviously smoking is quite rightly a declining activity, and there are these new forms of cigarettes or smoking, and there's a lot of fears of disruption in that area. So I mean, we're less heavy in the sector than we have been relative to the index, but it's certainly been they've been very good income stocks over the years. But I don't think one should ever get too carried away. That ultimately, it's not very bad for your health, and so it's a question whether they can adapt to less bad forms of smoking. But there are kind of some disruptors there which people have been worrying about. So they have been quite weak this year. That's absolutely right.
Do they own kind of vaping companies?
Well, they do. But it's not. There's also some upstart. There's something called Juul in America, which has attracted young people a lot and seems to be winning a lot of share. But it's with particularly high nicotine dose. I'm not sure how good that is, for terms of the authorities. But so, there's a lot of concern. I mean, it's supposed to be a very defensive sector, but with this kind of disruption going on, people have been concerned about the longer term outlook. But the British American tobacco is yielding 5%. So from my point of view, we're not as heavy as we used to be, but it certainly is, quite interesting from an income point of view.
Yeah, and we talk about defensive sectors there. I mean, maybe there's a bigger question about where we are in the economic cycle. Markets have run for a long time now.
Yes.
We've been in a bull market for a long time. So, where's your thinking there? Do you think there's a downturn around the corner?
Well, that's a very good question. I mean, I think global growth's been pretty good last few years. And in America, you've had this boost with the tax cuts from the Trump administration. But you are seeing rising interest rates in America in particular. And my view is we'll get an increase in the UK to 0.75 this year. Because I think the central banks to some extent want to normalise interest rates, and if they don't raise them a bit, then they won't be able to cut them for the next downturn. Is the way I look at it. So, you're right. It's been a long bull market, but these cycles can go on longer than you think possible. And certainly at the moment, the employment's fairly strong, and growth is pretty good. I mean, last year was a particularly good year. Europe slowed a bit this year, but it's overall growth's pretty good out there. So, I think we need to watch the bond yield factor a bit, because obviously, if bond yields go up, that could destabilise things a bit. But I think at the moment, when inflation still seems quite low, it's heading back towards the UK government's target here in Britain. So I'm not too worried. So I think at the moment, I agree with you, the cycle's gone on a long time, but I can't see anything to turn it at this very, very moment.
Are you worried, Cherry?
I think there are vulnerable areas where there's an awful lot of expectation, and share prices have moved a long way. And yes, there have been the earnings to support it. I think we can possibly think which sectors I have in mind, but and the earnings a bit. And I just worry that if at any point those earnings start to evaporate, then those sectors will be hit really hard. There seems to be a lot of kind of punishment for failure in the markets at the moment, more than there is kind of upside for success. So yeah, I think there are vulnerable areas, but actually not particularly in the UK. I would have said among the you may disagree with me, but not particularly among the UK market. I think the Brexit effect has sort of kept prices reasonably stable and yeah.
Okay, Joe, what do you think of the UK government's proposal for new powers to block foreign takeovers?
Yes, I haven't read them in detail, but previously the government's been allowed to block takeovers on defence grounds, I think, and I think they're enhancing those powers. But I think I haven't really read the detail of it. But I believe in an open market for corporate control. I think it means that management don't get complacent and they can they can be removed. I think if necessary. Having said that, I believe companies should be managed for the long term, and I'm against. I'd be against sort of companies. I wouldn't want companies to be run too much on a short-term basis, try and keep off takeover shots. But it's difficult to comment really without seeing the devil's in the detail of what the government's proposing. And but I don't think it'll affect too many takeovers. I can't see them extending it too much.
Mm-hmm. Will you shift the portfolio towards domestic sales-based companies in a no-deal scenario?
I think an opportunity is emerging in the more domestic stocks, but I would probably, whatever scenario happens, I would like to get some more clarity on the domestic economy, and I think then there could be an opportunity to be slightly higher in the mid-cap than we are at the moment. We're about 16% in mid-cap, 72% FTSE, 12 overseas, and so we've been as high as mid-20s mid-cap, and the mid-cap stocks tend to be a bit more domestic. So I think there could be an opportunity emerging. I don't think it's quite there at the moment, but I think we need a bit more clarity over the outlook for the UK.
Okay, well, I'm afraid that's all we've got time for today. It's been very nice to speak to you. Thank you so much for coming into this studio. It's been a real pleasure, and I'd like to thank you for joining us as well. We hope you enjoyed today's episodes and were able to get some of those answers to those burning questions and maybe some food for thought to take away. A recording of this episode will be available shortly on the Trust TV tab of Janus Henderson's Investment Trust homepage. For any more information about the City of London Investment Trust, please visit cityinvestmenttrust.com. Until next time, goodbye.